What's going on, Cashflow hackers? It's Chris with Life 180, and today we are in video number 3 of the whole life insurance masterclass with Life 180. And if you are just getting here, it's your first time here, I want you to first and foremost pause this, make sure you go and check out the first 2 videos. If you have not watched them, it's going to be essential for your success to go back and watch those videos and then come back to this video. I'm going to put a link in the description below for the playlist that this masterclass is part of. And I would really encourage you, if you're just finding this video for the first time, click on that playlist and watch the video in sequential order. It'll help you get the best experience out of all of the things that we're communicating in this masterclass. So without further ado, let's get into it. So last video, we talked about the hierarchy of financial needs, and I showed this image back here about what the important elements of how to structure your world of personal finances. Most people are going about it all wrong. They're investing too early. They're not saving enough money. They're investing. They're taking on too much risk, and therefore they're becoming speculators, not investors. And so the question is, we haven't talked a lot about whole life insurance yet. And so this video, what I want to do is I want to talk about the 5 different ways that you can utilize whole life insurance and show you how it kind of grows with you as you go through life. And I think it's also going to start to make sense, and all the dots are going to start getting connected on, because you're able to use it in all these different ways, that no matter where you are right now, whether you need to build an emergency fund or you're in debt and you have all these things going on, we can help you solve that problem. If you are somebody who's maybe has some assets and is looking to take it to the next level, and you're looking to get some protection in place and looking to add a little efficiency and take control of the banking function and take control of opportunity costs and have a way to control cost of capital, these sorts of things, we're going to show you that as well. And so without further ado, let's just get into it. I'm going to share my screen, and what I want to do here is just recap, right? So you can see that with this hierarchy of financial needs, what we have is, starts from the bottom, we're going cash flow, financial safety. Once you build your financial safety, then, which is your emergency fund, your insurances, then you can start worrying about accumulating wealth. During that phase, you're paying down debt, you're investing in cash flow, compounding the cash flow, you reach your financial freedom, and then you can really start focusing on legacy. If you didn't watch last video, go back and watch it. If you did, you know exactly what I'm talking about. I'm not spending a lot of time there. So that said, let's talk about whole life insurance. These are the 5 areas right here. I'm not going to hide it from you. I'm just going to show you what they all are. But I think it's important. Don't just read these and click away, because if you do, you're going to miss why they're so important and why it's essential to use whole life insurance, and what I believe the reason is whole life insurance is the best financial vehicle for all of these necessities in our life. And ultimately, you may not even realize that these are necessities for you, but we're going to talk about them in good depth here. So let's start with number 1, your emergency fund. Now, the emergency fund is something that I think everybody knows what it is. People like Dave Ramsey, Susie Orman will tell you that you need 6 months. This is of income, right? For 6 months of life expenses, right? Lifestyle expenses, depending on who you're talking to, right? So you need 6 months. Question I have is, why 6 months? Because when we look at an emergency fund, the thing I'm thinking about is an emergency. So when they say 6 months, what are they saying? They're saying you need 6 months of an emergency fund because they're worried you're going to what? Lose your job. So they're worried you're going to lose your job. I don't know about you, but to me, losing your job is not much of an emergency. You have the ability to go out and be saved. Now, like, go out and get another job and ultimately find gainful employment in some way, shape, or form. If you're constituting losing your job for 6 months as a complete emergency, I would really encourage you to think a little bigger. Because to me, when we think about an emergency and I think about, all right, where are we supposed to save money? Most people are saying, all right, I'm going to save my money in a savings account, or I'm going to use my investment account, like my 401k. I have it there, right? So people use these 2 vehicles typically for their emergency fund. Maybe they don't do it even on purpose. Their 401k just becomes their default emergency fund because they don't know what else to do, and that's just where they're investing their money, because they're not saving, they're investing. So that's where all their capital that they could ever potentially have access to is. And then ultimately, a savings account is just because that's what people know. It's a bank account, right? It's where we put it. And even though, historically speaking, you're losing money to inflation when you put money in a savings account, The fact that you have the money there, the fact that it's guaranteed and it's liquid if you need it, is a big attraction that has people wanting to keep money in their savings account. Now, that said, I don't believe you should have much money in a savings account at all. I believe you should have your emergency fund saved in a whole life policy. Why do I believe that? Why do I think we should have an emergency fund inside of a whole life policy? First of all, what do we constitute as an emergency? Well, I would say we constitute an emergency as beyond getting sick, something like a critical illness, physical accident, maybe cancer. You know, real emergencies, right? These to me, stuff of that nature is what I would constitute an emergency. Now, I don't know about you, but for me, having 6 months of savings, if some of these things happen, it might help you, bridge the gap just a little bit, but it's not going to be the solution for your problems. And so when I look at this and I look at an emergency fund, I think, what are the needs? I need it to protect me in case I lose a job. I need it to protect me in case I get sick, in case I have an accident, maybe a car accident. My wife, I share the story. My wife and I got in a car accident in 2015. She got a concussion, really bad, hit her head. And because of that, has been dealing with traumatic brain injury consequences ever since. And in fact, long story short, because before that, she was going through recovery. She's been clean and sober now since 2009, but she was not insurable because if you know anything about getting insurance, she wasn't insurable. And then therefore, she was not able to get insurance. And then we had this accident, and then she got a traumatic brain injury, and it's made it even harder. So I would say don't take your insurability for granted. These accidents happen. And what happens if, like my wife, I don't know, I've shared this a little bit. If it's your first time here, first time watching any of my videos, she was unable to really even look at a computer screen for 2 years. Her job was online marketing. That's what she did. She worked for Google as a consultant. So when you lose that ability to do your job, that counts as a cognitive disability, which accounts for critical illness. She would have been covered had we been able to have that. And so for me, I have a real reason for wanting to do that. Cancer, I'm gonna get to this a little bit more for living benefits in retirement right here. But my father-in-law was diagnosed with stage 4 pancreatic cancer in 2020, November 4th. And I tell you what, having access to the death benefit while he was alive has kept him alive. They gave him 90 days to live when he had cancer. And by utilizing and accelerating the death benefit of his life insurance policy, he was able to pay for alternative medical treatment. And the oncologists and the traditional doctors are still confused how he's still alive 4 years later. Yet here he is playing golf 4 times a week and hanging out with his grandkids and loving life, right? That's just, it's an amazing thing. And so to me, when I think of emergencies, these are the things that I talk about. Make no mistake about it. Cancer happens to people even in their 30s and their 40s and their 50s. This is the stuff that we need to be protected against. This is what emergency funds need to be focused on. Now, a lot of people would say that whole life insurance is not a good emergency fund because if you have to keep paying a premium while an emergency happens, well, that just becomes a stress. But bottom line is I could show you a way that if you're saving $20,000 per year, I could show you a way that the minimum could be $2,000 per year, for instance, right? And if that's the case, just to keep it simple, out of this $2,000 per year, you could have the dividends pay the $2,000 with what's called a premium offset. So these things happen. There's other flexibilities that you can build into it, but once again, you've got to design the policy to meet your goals. So this is first and foremost, I think, when we talk about we want to build an emergency fund, we have to make sure our emergency fund, when we're looking at the foundational elements, right? This is obviously assuming that you are, you've got your cash flow and basic needs set up. Now we're building that financial safety, the emergency fund, and insurances. By having your whole life in place, it's kind of accomplishing your emergency fund and your insurances all in one. Now, obviously, you got to have your auto, your home, umbrella, any other insurances that you need. It's got to be there, but it's really important, I think, to realize that there's no more efficient place than a whole life policy to keep your emergency fund. We always say that putting your money in a whole life policy is basically getting each dollar to perform multiple functions. And as I go through this, I think you're going to start to see like every dollar is actually growing and creating flexibility in my life and creating opportunity in my life and solving different problems for me as I age. And you can't negate the value that brings to the table. So let's talk about number 2, opportunity fund. So now we're starting to talk about the need to accumulate wealth, right? We've saved money, we've built our foundation, we feel good, we want to accumulate wealth. The buy and hold investment strategy in the world that your traditional financial advisor would have you follow, to me, that's a busted model. It doesn't work. If it did work, 95% of the people in this country would not be reaching retirement, not able to maintain their standard of living. That's the problem. If somebody told me 50 or 60% of people were reaching retirement and not able to maintain their standard of living, I could say, all right, people are just not being accountable enough. They're not taking enough accountability for the results in their own life. And at the end of the day, 95% to me means there's a systemic problem, that the model that we're leveraging of the go to school, get a job, invest in a 401k, buy stocks and bonds and all these things, it's just not working, right? And so what I look at is this accumulation phase. We want to make sure, depending on what we have, we want to make sure our debt, especially our toxic debt, is down. We want to build this opportunity fund up. And then as that's there, I want to invest in cash flow producing assets. So the beautiful thing is, for an opportunity fund, we want to make sure we have money that is available, it's liquid, it's accessible, we control it. I love saying whole life insurance is the best place for an opportunity fund because it's a self-completing plan. The way I look at it is that I'm building my life, I'm building my portfolio, I'm building my cash flow, I'm building for my financial future, not just for me, but for my kids as well. So to me, it's not just about what I'm creating in this life. Obviously, I want to reach financial freedom. I want to be able to have an impact. I want to do all these things, but really it's about what am I creating for my kids. Remember, if we go back to the first video in the series, we were talking about what problems are we trying to solve. To me, a big part of the problem I'm trying to solve is, what does the legacy look like? What do the rules look like that my kids are going to have to live by? How do I create those rules? Can I create those rules? How am I going to make this impact for my kids' lives as best as possible? How am I going to make a multi-generational ripple effect? And when we look at the opportunity fund, the reason I think this is so important is because as we look at this idea of a self-completing plan is huge, because I'm saving here, right, in this fund. But what happens is if I save it in a savings account, right, and if I have my emergency fund in a savings account, well, then I die, then they only have the money that's in the savings account. But if I have money inside of my whole life policy, right, and I'm going to use red to go down here. If I have money inside of a whole life policy, then what happens is it's a self-completing plan. If something happens to me, it self-completes, meaning the death benefit pays out and everything that I was trying to save up for that opportunity to create automatically happens. So I use the phrase a lot. And I'm going to try to use a different color here because this is not working for me. I use this phrase a lot, is buy your net worth, build cash flow. Okay? So if you buy your net worth and you build your cash flow, what I'm talking about is you want to save in your emergency fund, you want to build an opportunity fund, so you're doing this, but you're at the same time, you're doing it through whole life insurance and through a convertible term policy. You're buying your net worth, whatever the amount of money the insurance company will give you. Like I just got another $2 million of term insurance the other day because the insurance company would give it to me. And so the reason that I do that is because the insurance company is never going to give you more money than your potential net worth given your current set of circumstances is. And so for me, if I have the ability to buy that net worth, it allows me to gamify my life. By buying this net worth, I know that I've said, all right, if my net worth is potential, even though my net worth now isn't that, but if my potential, if the life insurance company says based on your current income, a multiple of that, the debts, the assets, everything that you have, this is what we think your potential net worth is. They call it a human life value. That's the technical term. What they're going to do is they're going to say, we're going to give you a number. Let's say it's $10 million. So I want to buy $10 million. I'm going to buy this. And then while I have this number there, I'm going to build my cash flow, because now what am I doing? I'm trying to build my cash flow, and I'm building cash flow. I'm investing in things like real estate, right? maybe I'm going to buy a business. Maybe I'm going to invest in real estate. Maybe I'm going to use this money to be a private money lender because I know what I'm doing. But at the end of the day, as I'm saving and as I'm trying to build my cash flow here, what happens is if I die, this whole plan self-completes. In this example I was using, this $10 million automatically actualizes. Now maybe as I was doing all this stuff, maybe this opportunity fund that I was working so hard for, as I was saving and building, and maybe I had a couple houses, maybe I had a couple deals going, maybe I have a business, but my net worth was only like 3 million. Well, guess what? If I'm really trying to create a legacy, doing what I'm talking about, buying my net worth ahead of time allows me to gamify. And think about the peace of mind that comes with that, because having that peace of mind as I'm building and trying to provide and trying to create for my family, having that peace of mind allows you to just execute, and it takes a lot of the stress off of everything. And that's why I call it gamifying life, because it is just an injection of peace into life, knowing that even if you screw up, that this death benefit is on the back end and it's guaranteed and it's there, right? To me, that is massively powerful, okay? So the next thing, we've got through these phases, right? So we've used this volatility buffer, or we've used the opportunity fund, we've built up, we've gotten to the point where we've reached our goals, right? So I'm gonna erase some of this so I have more room to work with here. So we've reached some of our goals, and that's fantastic. So we've got our goals, we've had success, we've hit retirement. So now we've hit retirement. As we hit retirement, what do we have to think about? We have to think about basically our money lasting us forever, right? Anybody ever hear of the 60-40 portfolio? Look it up. Basically, it says 60% bonds, 60% equities, my bad. 60% equities and 40% bonds, okay? The problem is this was the gold standard in retirement planning for decades, ever since 401ks and qualified accounts and the new kind of way of retiring, traditional ways of retiring. This is the way that people leaned on for retirement planning success. This was the gold standard. Now, what happened in 2021, 2022 is equities went down, bonds went down. For the first time in history, 2 years consecutive. 2 years in a row, bonds and equities went down. That means people in retirement got absolutely destroyed, because it was supposed to be you had 60% equities and 40% bonds, because the purpose of the 40% bonds was you could lean on the bonds in negative years. That would allow this 60% part of your portfolio to recover, and that would allow you to get more runway out of everything. Now, whole life insurance, if you look at anything, and once again, I always say we got to think long term, right? So as we think long term and we think through all this, and we're thinking about, all right, whole life insurance is a better bond. I've done videos on this before, as whole life insurance is a better bond. Why do I say that? Well, we have to look long term, because if you look for every 10-year period, bonds beat whole life, right? So every 10-year period, this is what I get from people when they go, oh, Chris, you're foolish, you don't get it. Whole life insurance is not that good. Why would I put money in whole life insurance? I can look at the bond market right now. I can look at CDs. I can look at high yield savings accounts, and so on and so forth. But the bottom line is, it's not about today. It's about thinking long term, because you don't care that, the returns of the whole life policy, right, are not about right now, right? When we look at the bonds, you're not buying bonds because you need the liquidity in that money right now. The fact is that you're going to have liquidity, use, and control of this money the entire time through your emergency fund and opportunity fund. And once you hit down the line and you want to kind of retire and be free, if you want that bond alternative here, now we have to be thinking long term. Whole life, every 30-year period recorded for the last 80 years, whole life beats bonds over every 30-year time frame on a rolling basis for the past 80 years. And so when we think about solving long-term problems, we need to come up with tools that will, so that will do that. And so the fact that we can have this product that will beat bonds on a long-term basis and get us death benefit and allow us to use it as an opportunity fund while we're saving and growing, and provide us an emergency fund that's a real emergency that will give us these living benefits, which is what I'm going to roll to. I said in retirement here for number 4, but at the end of the day, living benefits, if you become critically, chronically, or terminally ill, if you get cancer, if you get 2 out of 6 daily living activities and cognitive impairment, these are the things that come into play where you get access to your death benefit. It doesn't matter how old you are, it just matters that you have the policy in place. And so this one account is able to do all these different things. And then ultimately, the mecca that everybody thinks, at some point in time, sadly, we're all going to leave this world and we're going to die, right? We don't want to, but it's something we can't fight, so we might as well plan for the inevitable demise, of our breathing body, right? I mean, that's just the reality of the scenario. Now, I don't know about you, but it's important for me. If I know that I'm doing this, and I said it the other day, or I said it in the other video that I just filmed, if I were to talk to every 90-year-old on their deathbed, and I were to ask them, do you wish you had insurance right now? Do you think they would say yes or no? Do you wish you had more money that you could pass tax-free to your family? Do you think they're going to say yes or no? I know that they're going to say yes 99% of the time. And I know that the one person who doesn't care, doesn't want to do that, is not somebody that I'm going to spend a lot of time with. And I probably wouldn't have spent a lot of time with them in life. So what I know to be true when we think about this, and you see this just in alignment in values and beliefs. I said when we go back to the problem, right? Like we go back to the problem. Now take a look at this. I think it's so important, okay? Talk about the problem. Not aligning your money with your values and beliefs, right? So this is a big thing. Like focusing on rate of return instead of results. What is the result? I really encourage everybody to go back, and if you haven't, make sure you download that PDF, the 13-day values and beliefs workbook. It's going to be so valuable to you. Focus on that and get the rate of result focused on. Focus on structure, efficiency, and control of money. This is the banking function, cost of capital, and then opportunity cost, understanding these things. And I'll tell you this, you can only do those things. You can only have that structure and control cost of capital and control opportunity cost by having an opportunity fund, by having your emergency fund, by being able to access cost of capital. If you were to go to a bank right now and try to buy a real estate investment property, you're going to pay 7.5% to 8% at the time I'm filming this video. I don't know when you're watching this, maybe rates have gone down, maybe they've gone up, but at this moment in time, 7.5%. At this moment in time, to be able to borrow against your whole life policy, it's 5.5%. So what is the value of being able to control that cost of capital? What would be the value if you could rent it out or lend the money out at 5%, 5.5%, and you could charge 15%? And all the while, that money's going to keep growing for you. There's all these different things that we could talk about, but at the end of the day, aligning your money with your values and beliefs. When we look at this hierarchy, when we think about, all right, do we want to be able to have control of our results? To me, that's a value, I believe. I want control. I want to be able to control all the dynamics, and I want to become who I need to be to create the life that I want for myself and that I want for my heirs. That's number one. Then I know that to do that, I got to build financial safety first. This is why I always say you got to be willing to go slow to go fast. If it took you 3 or 4 years of feeling like you're missing out of opportunity because your friends jumped ahead of you and started accumulating wealth and investing, well, guess what? The market is cyclical. It's not linear. It's going to go up. It's going to go down. You're going to catch up to them. This is the tortoise and the hare conversation. The hare is going to go out. The hare is going to buy and invest because they're impatient. You're going to be the tortoise and you're going to plod along. And then when the hare crashes, you're just going to go buy them when they're crashed. That's just the way this goes, okay? And then you're going to want to reach financial freedom, and then you're going to want to put a legacy in there. If you don't align with this right now, if you don't align with wanting to create a legacy, and this is the end goal, and whatever, then you're in the wrong place. Go to a different channel. This is not the place for you. But if you align with this, then I'm telling you, now look at this. We got the emergency fund, one product here, one product in its versatility. The emergency fund, the opportunity fund, the volatility buffer for retirement, a bond alternative in retirement, being able to have control your medical directive with living benefits in retirement and before, and then having tax-free legacy planning. This is what it's all about, okay? Unfortunately, most people think of life insurance as just this. The people that think of buy a term and invest a difference don't even think about legacy because they're like, who cares? You don't need insurance. I'm not talking about what you need. I'm talking about what do you want, right? I always think about The Notebook. My wife and I watch The Notebook a lot. When Ryan Gosling, I think it's Amy Adams, were arguing, and she was like having this problem, and he's like, dude, what do you want? Tell me what you want. Like, I'm telling you, what do you want? What do you want for your family? You know, that's the way I look at it. If you want to do this, you have to align your money with your values and beliefs. You have to really connect with it. You really just have to. And I would argue, if you start thinking and start with the end in mind and reverse engineer a plan to get there, when you really think about what you value, what you believe, what you want your mission to be, what your purpose is in this life, and you get clear about your core values, and if they align with this is just where you got to start. You know, this is the foundation of everything. And by doing this, it's not going to create wealth for you. This is the thing. Whole life, unless you die, it'll create wealth for your family. But it's the backstop. That's the key here, right? When we look at this, whole life insurance is not going to, you know, create wealth for you unless you die. But what it's going to be, by buying your net worth and building your cash flow, it's building your cash flow, but the death benefit is the backstop to creating the wealth. And that's really what makes this whole system so magical. So a lot of people say it's the secret tool the wealthy use to create wealth. No, it's a secret tool the wealthy use to make sure they don't lose their wealth and to maybe help them accelerate it, maybe help them control some of the variables because it gives them a set of rules and a system and a filter to make all their decisions through. That's the key. So if you have any questions about this, comment in the comment section below. If you want to talk about this, if you're interested in learning how you could do this in your life, go down in the link in the description below, set up a clarity call with somebody on my team. I'll also make it as a pinned comment. You can go down there. If this is your first time here, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. I hope if it's your first time here, you're also going to go check out the playlist, which I will link in the top of the description and also next to the link on the pinned comment. And you can utilize that to go dive deeper into this playlist. So until next time, have a blessed, inspirational day. Hopefully you found value in it. We'll see you on the next one.